Hello and welcome to Bloomberg Quint. I'm in conversation with Mr. Sunil Sharma. He is the Chief Investment Officer with Sanctum Wealth Management. Sunil, thank you for joining us.
Thanks for having me.
Well, so we're here to talk about the markets and their outlooks, not only globally, but in Indian market context as well. And I'm going to start off with the US markets. The US markets are at lifetime highs, and to a certain extent, they are pricing in tax cuts, also very, very large infrastructural spends. But what are those concerns that the US markets are not pricing in right now, which may have implications later on?
It's a good question. So, what we've witnessed in the past 6 months is a consensus trade away from emerging markets and into developed markets in anticipation of a very strong fiscal stimulus by President Trump. Our positioning on this is that we think that there are a number of headwinds. Primary amongst them is the 3 Fed hikes by the Fed, which will be a headwind for US markets. We would add that the valuation of US markets is at extremely high levels relative to historical benchmarks. We would also point out that the consumer balance sheet is relatively weak as a result of some of the policies that have been in place over the past 2 decades. And we would think that inflation ticking up as well as a strong dollar are both additional factors of concern that investors are now just recognizing. Finally, we would suggest that there is a lack of clarity at this point in terms of what the stimulus is going to look like and how effective Mr. Trump's efforts to launch the stimulus will prove to be.
So, based on your outlook when it comes to the dollar, what does it mean for emerging markets? If you are expecting weakness in the dollar, can we expect more inflows? Because consensus is of the understanding that we could expect tepid inflows at least in this coming year.
Okay. Yeah, so what we would think is that there is a recognition, and there was a lack of recognition earlier, that the fiscal stimulus would be implemented relatively effectively. And today, there's a recognition that the fiscal stimulus will not come through in a manner that markets were expecting. And what's happened is that there is now a recognition that some of the factors in emerging markets are quite attractive. And so we're seeing a rotation of the monies that left emerging markets come back over the past month and this month back into economies like India. So I think the clarity will emerge as details about President Trump's fiscal stimulus plan emerges, and as clarity emerges about in terms of how effective and how easy it will be to implement that.
Right. How are you reading earnings, and how are you reading valuations with where equities stand right now in India?
So this quarter was very impressive for us, and particularly in the face of demonetization.
Right.
The ability of Indian corporates to deliver earnings growth of the type that is actually, in our opinion, far better than in the previous 2 quarters is a good sign about the future prospects for earnings. We are also seeing transmission come through as a result of demonetization, which will help margins. And we also think as a result of demonetization, there will be marginal improvement in operating profitability. And that too bodes well for earnings. And then we would finally add the fact that the budget and the fiscal prudence that was demonstrated will also be contributing in terms of earnings prospects for the year. So we're quite positive in terms of earnings growth.
You know, you've also said that you're not shying away from debt, but for now, fixed income seems slightly riskier as compared to equity. Could you explain that for us?
So what I would say is that fixed income today, and we're talking about GSECs, fixed income today has a level of risk associated with it that we have not experienced in the past few years. And we've been working with a declining interest rate environment. And so today we are now, it's clear that the cycle with the RBI's decision to move to neutral and with the uptick in inflation, we are now looking at a cycle that has possibly bottomed. And our call was that it bottomed sometime in late November, early December. And so fixed income to us becomes a class that must be approached with a different perspective than what investors have done so in the past few years. And taking that into account, and the level of the interest rates today that investors and the yield that investors would look to earn on a relative risk-return basis, equities is a relatively more attractive asset class.
Right. Okay, so I'm going to come to the financial sector, and I have two questions there. The first one is, of course, the private sector banks, and I believe that you guys like private sector more than the PSUs right now. There is a lot of speculation of consolidation, a lot of mergers. Should some of these come through, and I'm sure you must be knowing at least of some of them, would it be beneficial for the sector in general?
Absolutely. So first of all, yes, we have been participating in the private sector bank space, and it's done very well for us.
Right.
And what we would say is that we are closely watching developments in the public sector banking space, because reforms are finally coming through and efforts are being made to make these entities more effective and more productive. And so as those efforts come through in the numbers, we would certainly be looking to participate in that space. And reforms would be, and we are hoping, because of the fact that today we need the banking system to be able to lend effectively, we are hoping that these reforms will come through effectively and rapidly.
Okay, and my second question in financials is that you said that you like selective NBFCs. Would they be microfinance companies, housing finance companies? Where would your preference lie?
So we have not gotten exposure to microfinance companies, and we were heavily invested into NBFCs over the course of the last year.
Right.
And so we're sticking with that position for now. We would not be looking to add to financial exposure at this point in time, just because of where we are in the business cycle.
Right.
But we are sticking with our exposure in housing finance is one part of what we're looking at. And capital markets is another area that we also own in the financial sector.
Right. My final question is that you have suggested this is a stock pickers market. I understand you can't talk about stocks specifically, but what are those other areas of opportunities that you find in the market right now, which may be undervalued, or which may have a good opportunity with respect to returns going forward?
So one of the sectors that I think is finally getting the recognition that it deserves as a growth sector is energy. Right. And so we have participated in the energy space over the past year, in the OMCs and the natural gas space. And we think that the prospects for growth for that sector remain bright. And I think the recognition is finally coming around in terms of the prospects for this sector, given the global environment that we are looking at from an alternative energy perspective. So we are positive on that space.
Okay. Well, Sunil, it was a pleasure speaking with you. Thank you very much for your time.
Great. Nice talking to you too. Thank you.
Thank you.